What's happened in this cycle is every known recession indicator that anyone has ever known about has been blown to smithereens. None of them have worked. How is it that 4 years into an official uninterrupted economic recovery and 2 years, 2 years in a bull market, that you ask Main Street how they're doing, and they're telling you we're still stuck in the midst of one of the worst recessions in post-war history? No other Fed that eased all the way up a major inflation cycle that have tightened all the way down. And um, the question, is why? Because, people that are saying, well, it's overvalued compared to the last 50 years or whatever, they're right by the data, but it's kind of meaningless.
So Matt, today we got clips and we're going to talk about the highlights from our interview with Jim Paulsen.
Jim Paulsen is just one of these all-around fascinating guys that you're so used to seeing somebody like this pigeonholed and truncated down to these little soundbite clips. And this is a reminder, this episode, which I was literally floored by how much I enjoyed this episode. I just didn't see this coming because I'm so used to hearing this guy in these little short truncated clips. When you let this guy stretch out, holy crap, there's so many useful indicators, recession ideas, tracking tools, just brilliant insight after brilliant insight. I loved hearing the nuance in his answers.
And it's funny because, a lot of times when we're prepping for these interviews, we watch what other people have done. And when you have somebody who's primarily been on CNBC, like this trap I fall into is I'm like, I need 200 questions for this person because all their answers are like 1 minute long. And so like I prepped all kinds of stuff for this. And then you realize, Jim can give incredible, like in-depth answers. And he doesn't do long form a lot. So like I was prepping for the completely wrong thing because I'd only seen him on CNBC.
Yeah. So all the other finance podcasts out there listening and watching this, like get this guy as a guest, listen to some of these answers, the nuance from macro all the way down to micro, really, really powerful and really just so interesting as a communicator of these ideas to just watch him unpack this logic through the steps as he takes it out. Really excited to share these clips today.
Yeah, you and I were talking before. It's rare for me to do one of these interviews and I'm like, and hear something significant where I'm like, I never thought about it that way before because we do so many of these. And there's like at least 3 or 4 things we're going to go over today where I'm like, I understood that concept, but I've never thought about it that way.
I love a person who can, give you an indicator, for example, that you go, everybody says this and, wait for it when we get to it. Everybody says this, but nobody's actually told me here's the indicator and how they track this, especially with a novel approach. Paulsen's just full of cool stuff like this.
Yeah. So our first question, one of the things we love to talk to people about who have had really long careers on Wall Street is so much has changed on Wall Street over the years. So we like to ask them, what are the biggest things they think have changed? So here's how Jim answered that.
This is 40 years ago. I'm lucky if I'll remember. But, I just think the biggest thing is the amount of information that you have in front of you. And I'm not so sure it's better or worse. That's an open debate. But like when I started, we had no PCs yet, guys. I mean, only certain of us oldies can remember that. There was nothing like a PC computer. A lot of us didn't yet when I first started have Quotrons. Okay. So literally this is true. We would work in the morning and then when you went to lunch, you went by the local bank with the digital clock out front, gave you a time temp and what the Dow was doing. Once a day, we got a feed on what the Dow Jones was doing for the market that day. And basically outside of that, you read annual reports, you read Wall Street research, and you're busy doing your thing. That is so different. But where people that actually have time to sit down and read a full article all the way through and, and golf the whole thing, I think is almost a rarity today. Used to read Barron's cover to cover on the weekends and all the papers. It used to be a regular part of your routine. And today it's just skim. It's just too much to take in. We also didn't have a lot of data to really go at. The number of economic reports released every month was maybe 50% of what we see today just on the regular monthly feeds, if that. There was kind of like 2 inflation reports and, it really wasn't like 80 million of each economic variable reported over and over again in different metrics. And the amount and type of information that you can take in and then also now quickly manipulate and look at. When I started, we'd build a valuation model on a spreadsheet and enter in a HP 32E calculator with the beautiful thing, putting data stripes through it. People remember this, but that's how that was the really antiquated way when you look back now that we used to help us to judge values in the stock. So it's night and day. Now, I don't know if it's better or worse, because in some ways I would argue that your judgment, which I've come to appreciate over the years, is what it's all about at the end of the day. It's not about the data and about how much you read. It's just about your judgment. I think that judgment needs a foundation and a base and a constant feeding. And in some sense, I think it's lost when it's jumps so quickly between so much data. It takes so much brain power just to figure out what you should even keep versus to star. I think a lot of time is lost in that today. So I think that's the biggest thing. There's some sub things too, Justin. I think the market focus was much more value oriented back then than it is today, has been. Even if you're a growth manager, you spend a lot of time on that. Today, I think we spend less because valuation ranges have been blown apart and don't work as well. And some of that overall. But I also think that the focus back then was longer term, just in general. Even short-term traders had a little longer-term focus of the markets. Today, it's so short-term. Even long-term investors are forced almost into short-term considerations. So those would be the main things I guess I'm saying. What has not changed is that at the end of the day, it is still run only by two things. It discovered long before I came on the scene, and that is UNR's motions of feeding greed that is still drives really what happens. That is what the ability to push up greed to have an onslaught fall of fear is what ultimately drives the market, and for that matter, the economy too.
Yeah, he touched on a bunch of different things here, and some things we're going to touch on throughout the interview because of how they impact the markets. But this idea of, obviously there's way more information. I didn't know this thing about, they saw the Dow like walking by the clock or something is the only way you knew what the Dow had done on a given day. That's crazy.
I mean, I guess it's one of those things, like you look out the window and you look for the sign of the ticker scrolling by the prices or something. But it makes sense. The Jack Schwager interview that we just released, this was a huge part of him talking about the 70s, 80s, and 90s. It was like, you can't even really talk about what people were doing or coming up with in that era and relate it to today, because the technology is not even just night and day difference. Like, we're talking dark ages to modern technology difference by extension, like charting on, paper and stuff like that, or getting like one Dow quote a day. And now you're going to go do macro. Can you even imagine what that was like operating without a stupid smartphone in your pocket all the time?
Yeah, and if you think about it, like today, like when anything gets released, like an earnings report or a CPI or something, you've got like bots like trading it within milliseconds of it, and like these guys didn't even know the data like for a while. You had to go like figure out what's going on. It's crazy to think about those two types of markets. And to his point in the interview, it's probably more bad than it is good. I don't know if all this information we're getting thrown at us is doing any good for anybody in terms of, I guess, people who know how to use it and can use it better than the market, but those people are few and far between. I think for most investors, like all of this data is probably not the greatest thing.
Probably not the greatest thing, and it's useful in a different way. And I think that's one of my takeaways from him is the way the information is shared and processed is now used in a different way. So be careful with your historical perspectives on this stuff. Back then, if there was even a Fed announcement to redline, somebody actually had to go through the literal printout of the document and redline the statement. Now, the Fed makes a policy decision, and FactSet, Bloomberg, whatever you use, in seconds is going to give you the full redline press release of here are the changes from the last statement and all the other stuff. That changes the way people interact with information, and it's actually a really powerful insight to when we think about historical returns, numbers, data, and everything else. So love getting that perspective from Jim.
Yeah, and it is interesting because you're probably those Fed statements are in AI like in a split second, basically once they come out. And like before you even know it, before you can even read the first paragraph of the thing, you already know what's changed and the market's already reacting to what's changed. Because again, all these bots and everyone's out there trading it already. It's just a completely different world.
Yeah. So how are you going to have an edge against that as a person? And if you want to have an edge, it better be in bot space, right? That's how it feels.
But what I thought he said was really important is that fear and greed will always drive the market. And I think that's so crucial to understand. And in a lot of ways, fear and greed probably drive the market more now than they do then, because all of this information feeds into the fear and the greed.
In your interactions with Claude, do you ever see fear struck into its cold, dead robotic heart? Or do you feel Like, have you experienced fear and greed in AI yet?
I don't think I'm hoping that's not coming, but I guess it is probably coming, right? Claude probably will have emotions and fear and greed and stuff. But yeah, right now, no. Claude is actually good for me to deal with my own fear and greed by getting unbiased opinions about stuff.
Okay, I'll take that for what it is. There's sometimes when I catch some like emotional nuance in a response, and I know it's just something I've trained into the AI or that's already there in default. But I wonder, I'm like, where's the fear and greed? Where are the cognitive foibles manifesting in some weird way? Because something is end running me, and I don't trust this.
There was something I read at one point that like if you ask nicely to these things, like you get better responses in some way. So maybe there is some degree of emotion that exists in these things. Like so, I always say please and thank you for a lot of different reasons. Apparently, maybe it also helps you get better responses.
I don't know. I'm of that too. I still can't I can't emotionally watch. I don't know if you saw that social media video going around of the people like kicking the walking robot. Like I can't handle that. It's that old thing about like where somebody's being mean to a dot on a screen, and I'm like, yes, I am emotionally anchored to please don't be mean to the non-sentient dot. I don't know. I'll say please and thank you with you. What else we got from Jim before we talk about our overlords and their fear and greed for too long?
Yeah, well, he alluded this in the end of the first answer, and this is really what the whole second answer was about, which is this idea that market valuations have been way above what historically they've been for a long time. And many people are talking about this idea that maybe market valuation or overall market valuation doesn't matter anymore. So here's how Jim talked about that.
It's not just the Schiller. If you look at the Schiller, you look at the trailing PE, and you can't really look at but the forward PE's tip because it only goes back to 1990 basically. But if you look at trailing 12-month of the Schiller PE or, five priced of trailing 5-year trail earnings, whatever you want to look, they all have similar style. You go back to 1870 to 1990, and the valuation range of the United States stock market was very stable. It was basically from 7 to 21 times earnings like clockwork. And when I started in business, we used that dramatic. I remember writing in 1986 that if the PE gets to 20, sell. Well, the PE got to 20 in 1987. And it was just like clockwork. It was never violated very stable range. Then it just blew apart, starting in the early 1990s. And I think on the Schiller, I can't give the exact numbers, but like the Schiller PE ratio has been above that previous range. If I go 7 to 20 times earnings or whatever, like 90% of the times it's the middle 90s. Like for 30 years, it's been chronically above the entire range it used to be from 1870 to 1990. Same thing with the trailing PE move. They've just not only just been a little out of bounds, they've been way out of bounds, and they've stayed persistently higher. So after about 3 or 4 decades, you got to ask yourself, is something different going on here? Because, people that are saying, well, it's overvalued compared to the last 50 years or whatever, they're right by the data, but it's kind of meaningless in some regard because they've almost always been overvalued for much of the last 3 decades, almost all the time. And so then you come to, why is that? What are the different things going on? And there's a number of things that could be contributed to it. One of them is that prior to World War II, the United States had recession half the time. Since 1980, we've had recession less than 10% of the time. Well, let's face it, if you have recession, 20% of the time that you used to have recession, then you can pay a higher multiple on things. And I think that's part of it. We just don't have recessions as frequent as we used to have. And let's face it, that's the biggest equity market risk is that you don't. Secondly, the market has become a lot more liquid, no doubt about it. I mean, even when I started, there wasn't nearly as many people that knew about it, involved in it one way or another. And certainly in not only in the United States, but just globally, it's become a massive liquid market. And we all know about liquidity. When it goes down, we get greater volatility and goes up. That's made a huge difference over that period of time. We also have very much gone from a industrial cyclical based economy and stock market, reflecting that, to basically a growth oriented, unit growth oriented, high unit growth oriented tech based economy, turned our cyclical based stocks we could invest in into basically what's more stable unit growths, if you will. Or that, as we all know, growth stocks receive higher valuations than value stocks. So we get a lot of that. So I think those are all reasons for it. One of the I think one of the big things that is discounted we're still learning about, and what I think you refer to, I talk about a little bit, is that I think we're also being radically affected by our technology here. And we are the unadulterated leader of this tech boom that's been going on now, at least for 40 years, probably at least 30. And the U.S. has been at the leadership of that at least since 1990. Maybe you could argue Japan was earlier, but the U.S. has dominated since then. I think has made a dramatic difference. This is not what we have done in the recent decades. We haven't created the automobile or the airplane that basically does the same thing today it did 120 years ago when it was first invented. I mean, the auto still runs on 4 rubber tires and goes down the road and gets you someplace. That's not what we do. These things are revolutionizing innovations that are doing things that we didn't even know existed before they were invented. That you just can't imagine. And not only that, but the companies that did it initially, those companies, IBM or whatever, they're doing something completely different today. They're no longer just producing the automobile forevermore. They're doing something completely different.
What I thought was interesting is I never really saw this that much in my career, but he was talking about like early in his career, how they could play mean reversion. Like the valuation would get to this high level and it would get to this low level. It would bounce back and forth. And then something changed and it just broke through and it stayed above forever after that.
This is that weird thing when you see in the JP Morgan Guide to the Markets or wherever you pull this data out, where you see those, here's the PE multiple over the last, 50, 100 years or less if you're looking at forward Ps and that kind of stuff since we've been tracking it. And you go, okay, I can throw an average on this. I can throw a median on this. I can throw standard deviations above this and say I'm at 1, 2, 3 above average. All that stuff doesn't take into account how many things have changed over that period of time. This goes back to that technological observation he made, both the tools that the analysis is done by and the reality of the firms who are in the index. You can't look back on this stuff and not have some questions. What did he say? After 3 or 4 decades, you should ask yourself if something else is going on. Like, yes, you should.
And he did a really good job of listing, probably the best I've seen, of listing all those reasons. We have way less recessions. The market's way more liquid. We have we have gone from an industrial economy to a tech economy. We have all these revolutionizing innovations. Like he did a really good job of spelling out a case for why, and I believe this. I'm a value guy, but I believe this. I may not believe the market valuation should be where it is now, but I do believe it should be above the historical average. I think there's a lot of reasons for that to be.
Yeah, I agree too. And I think, again, back to that thing, after several decades of being at above average, do you really want to argue that nothing's changed? That just the historical stuff should be there, that we're going back to, 1964? I don't.
And by the way, if we're going back to the long-term historical average, God help us all, because it's a long way down.
It's a long way down from here. It's a long way down.
This next clip plays into that same idea. And this is another reason he cited for above average market valuations. But this is one of the examples that goes back to what we talked about at the beginning. This is something that I've sort of understood, but he put it in a way I've never heard it before. So here's Jim talking about profit productivity.
So this is really dynamic innovation that I don't know if the modern world, and I just mean the United States since it's been in existence, has seen innovation like this. And one thing I would ask on valuations, how do you value a company like NVIDIA or Amazon when it first comes out? A company that when you look at it today, when it first comes out, won't even be doing anything remotely close to what it's doing today 5 years from now or 10 years from now. You'll be doing something completely new and different. I don't know how people even think they could put a value on that. And I think it's kind of silly that we try to do that to some degree. But I think what I'm getting at is I think it's fundamentally changed relationships that directly affect the valuation of securities. And let's give you one example. If I look at what I call profit productivity, you're not going to find this in the Econ 101 textbooks or anything. It's just a figure of mine that's, probably drank too much coffee one day and went there. But what I take was a ratio of U.S. corporate profits adjusted for inflation and divided by the level of employment in the United States. So to me, that's real profit per job. And to me, that's the ultimate in productivity for profits. If you can make $1 on every job, and then you suddenly make $2 on every job, that's profit productivity. That's my definition of it. Now, there's output per hour, there's all that, but that's profit productivity. And what does a corporation care more about? Yeah, that's pretty much the number one thing. What do you and I as stock investors care most about? Mostly that. I want profit productivity. Well, if I look at that, this ratio, I can only get the data back to 1950, but this ratio has been stayed range bound from 1950 until the early 90s. It was sideways movement. It very close with valuations, but it was range bound. And then since the early 90s, it has exploded. Can't give the exact numbers right now off the top of my head, but I think it's gone up 3 or 4-fold just since 90 after being range bound for decades. And that is the exact same moment with the valuation range of the global stock market, mainly the U.S. stock market, has also gone up over that same time period. So I think if something's delivering 4 times the profit productivity it used to deliver, you probably are willing to pay a higher valuation for.
This is so simple, but like, I don't know why I never looked at it this way, but like looking at profit per job across the economy and seeing that it was level for a very long time, and then in the 90s it exploded, tells you something is going on here that changed in the early 90s and has continued to get better. And like technological innovation is that thing, I would think.
Not only is technological innovation the thing, but what's really interesting in the data set looking back at this, you would think like, you know, the change in household formation and household workers. So basically like women entering the workforce, wage normalization to the degree that it's even remotely normalized, like all that kind of stuff, post-civil rights, like all of the stuff that you would think really started to drive efficiency. It's there, but it's range bound. And then all of a sudden in the 90s, as the technological landscape for workers change, as the advent of the emergence of the knowledge worker, all this stuff, that going off the charts, that says a lot about the change in the types of companies that are in the index. It tells you a lot about the change in the valuation of labor with workplace productivity, and probably where we are with the valuations in that prior point. That's an amazing way to frame where we are today back to labor and how it ties directly back to consumption. This is a really cool indicator. Have you ever heard this before? I know we hinted this in the intro.
I've never heard it put this way, and I think it's really cool. Like it's something I don't know if he even publishes it out there. I have to look, but if he does, it's something I'll keep track of going forward just to see. Because you would think with AI, like we were talking before we recorded, like people are saying, like some of the people in the tech space are saying, you know, we're gonna have like one person companies valued in the billions of dollars or something like that. So you think about what that'll do to a number like this. I mean, it could go up even more.
Yeah, imagine what the Schiller Cape is going to be then.
Okay. People like me, value guys like me, are going to be calling for like all kinds of declines after that.
Crying in your seats there. Fascinating though, and I love the idea of he took an idea about labor productivity and actually turned it into an indicator that seems to have. Not saying he's like buying or selling, trading off of these decisions, but that's an indicator now that I want to see on my dashboard. I want to actually be looking at this on a regular basis because I think that's a really interesting argument for why valuations are where they are, and into incorporating labor and inflation into that indicator too. Super cool.
Yeah, the other thing you got that I thought was really interesting is this idea of how do you even value like some of these innovative companies that are in the early stages, like how do you even value them? And obviously like data guys like me can't value them. I was just thinking about like Amazon early on, like you think about a bookseller that then sold all this other stuff and, you know, AWS and all this stuff. It's like, it reminded me of our thing with demotoring. The idea, the story is such a huge part of the valuation at that stage. You know, you don't really need to worry about numbers or what Amazon's making or what their margins are, or how fast they're growing. Like a lot of it was realizing what they were going to be able to do that they hadn't done yet.
Yeah. And I think Professor Demotorin is like the exact person to do for this because it's that story value of it's not really possible to value NVIDIA straight out the gate. It's not really possible. You can find corollaries and try to map that story and that stage in the corporate life cycle over what's there, but it's really hard to imagine what unfolds next. When you map in the impact on, and maybe this is the best part that comes out of a lot of like the shareholder stakeholder analysis that we've seen, all the crap that's come from this in the last like 10 years. But it's really interesting to think about in that lens too, especially what you just said about Amazon, because you think about what drives productivity for not just the workers of the company, but the consumers of that company and how that reshapes the growth path for this company. It would have been unthinkable to find another conglomerate that quite resembles where like a modern Amazon is today, 30, 40 years ago. Like there's just not a conglomerate. There's not an apples to apples comparison. There's nothing that Sears Roebuck did to become that type of entity, or even a GE. Really, really interesting to think of it that way.
So this next one, you're going to have a lot more insights on this than I do, but this is something I've thought about a lot because we've had a booming stock market for a really long time now, but the confidence of the average person on the street, I think he referred to as Main Street confidence, just didn't come up. And it's so interesting to think about why. So here's Jim's take on that.
We've had one very unique aspect since the pandemic, and that is there's been no recovery in Main Street confidence really since the pandemic. Now it was better by the pandemic and then inflation, whatever. But even after all the getting by all that, we still have consumer confidence measures that are closer to recession lows going back to 1950 than anything else. Small business confidence still almost in the toilet, one of its lowest levels going back to the 70s when they started recording it. How is it that 4 years into an official uninterrupted economic recovery and 2 years, 2 years in a bull market, that you ask Main Street how they're doing, and they're telling you we're still stuck in the midst of one of the worst recessions in post-war history? And that's really important because how the Main Street feels dictates what they do. And the reason they're not borrowing more, the reason they're maintaining such high levels of liquidity balances is because of their pessimism about the future. And to me, I think it's hard to have a recession when everyone out there, all your players, have been fully anticipating one imminently for the last 3 or 4 years, almost every day. How do you have a recession when everyone's waiting on one and fully prepared for? You have to have unpreparedness to get a recession, because that is when people are out over their skis and there's something for a recession to bite on that can cause a cataclysmic disaster. I don't think we have that today. There's not animal spirits on Main Street, nor in the stock market. Yeah, there's been a good stock market by some measure, no doubt, but I don't see the normal animal spirits. We haven't had runaway IPOs and M&A and a lot of that crazy stuff going on, and I certainly don't see it on Main Street. And to me, I think that's the most important thing. There's one other thing I'll come back to, but I think before this is over, we're going to finally resurrect confidence. And to me, that's the biggest asset still on the shelf that this new president could utilize, or someone else. When you take confidence where it's at back up to cycle highs or lands of recovery, man, oh man, that's a wonderful, lot of good things happen on Main Street, and a lot of good things happen on Wall Street. For example, if I go back to, I think 1952, and I look at all the months where the consumer confidence index rises month in, month out, versus all the months when it falls month in and month out, the difference for the total return for the S&P 500 over months rising, months falling, and the annualized basis is something like 20.5 versus 5.5. Okay. And since we're so low on confidence, we could have a long ways to raise confidence and probably more months of rising confidence than falling confidence, because it can't get a lot worse. And if you do that, that's a huge return, outsized return from the stock market, almost double its normal, if you will. And all one has to do to get that is to figure out the puzzle of how do you resurrect some confidence in this structure. And that's a whole other discussion. But to me, that's not something we generally have 4 years into an economic cycle, 2+ years into a bull. Confidence is already resurrected by now, and it hasn't done that. I also think that's why we've had a narrow stock market, one that really started very slowly, and one that has left most of the market not in a real bull. Some things that should be in a bull, like high beta stocks, have had the worst bull market to date of almost any, at least going back to 1990, I think I looked at. And I think that reflects the fact that a lot of people just don't look at this yet as any kind of bull cycle or economic cycle. So I'm optimistic, mainly because of pessimists. So there's room left in this thing.
So I'll hand this to you pretty quickly, but what he said that I thought was good is he said how Main Street feels dictates what they do. And it does feel like Main Street has never felt that optimistic post-pandemic, despite the fact that what we're seeing is huge numbers from the stock market and everything going up. I mean, do you agree with that?
Yeah, I completely agree with that. And this is something that I've said on here and I've said in multiple places, just over and over again. we don't think, and this is going to dovetail into the next clip when we get there too, is that like Main Street confidence, like what people are doing and basically are you employed and where and how are you spending your money dictate the economic cycle by and large. Like just full stop, 70% of GDP, give or take as it swings, is consumption. So if you basically look at like core consumption and understand what those habits are, you're going to understand a lot about confidence in the economy. Again, this is going to dovetail to the next clip that we're about to show too, but this is the big insight from Howe's generational theory and the fourth turning stuff. Not all that bad, but you got to understand who's in that peak earnings sweet spot and what's their set of experiences. You got a lot of bear markets, recessions, and ugly experiences in that like 35 to 55-year-old demographic. And that's going to keep people going like, I don't totally trust or I'm not totally confident in this thing all the way through. How else are you going to get to Fed communication policies? How else are you going to get to the worst bull market in high beta that we've seen? You've got this underlying layer of pessimism in this generation that's coming into or at peak earnings. And that is definitely something that's just going to sit there in markets and politics. And look at the last election. Why do we think people all around the world got thrown out all at once? Think about the experience of those people coming into their peak earnings years and how much they trust this stuff. That's embedded skepticism. It's really, really interesting to think about this way.
So I'm going to play that second clip you referenced in a second, but I want to go back to the market just for a second because it's sort of counterintuitive for people that this is actually potentially a positive thing for the market. On the confidence side, Jim thinks the confidence is coming around. Like we're starting to see some signs that confidence is increasing. And historically, when that's happened, that's been bullish for the market. And the other thing he mentioned, and I don't know if it was in this clip or the next one, but this idea that it's very hard to have a recession when everybody's looking for a recession. And so like both on the economic side and on the market side, you could argue there's positives in this fact that confidence has not come back yet.
Yeah, I'm optimistic mainly because of pessimism is a brilliant quote. And this resonates so deeply with me. We're coming off of the one-day tariff war and like all the other stuff we've had. And we said this on one of the other podcasts too. It's just this reality of if everybody's expecting it, or at least talking about a version of it, that worst case scenario probably is not going to play out because everybody's already at least somewhat tangentially aware of it. That is a really important thing to remember. This is the modern manifestation of the wall of worry in my mind. That's what this feels like.
So before the next clip, I do have to highlight that podcast you mentioned though, because it's Click Beta. It's a new podcast we put out. It's you, Jason Buck, Dave Nottig. It's really, really good. You talked about the one-day tariff war. You talked about a lot of other stuff. So anybody who's listening who likes our stuff, definitely subscribe. It's on our YouTube channel or it's Click Beta on all the podcast platforms. But now that I've done my marketing, let's go back to what we were talking about, which is here's Jim talking about this reason. You mentioned all this pessimism out there. Here's Jim talking about why.
There's a different attitude. There's not a big attitude to borrow money, I don't think, among the younger generation than there was when I was that age. It's more of the attitude of my parents coming out of the Depression, cash on the barrel. And I think we're kind of back to that again, which in some sense makes this economy much less risky. Might not be able to grow as fast over short spurts, but less risky.
And is that why when you talked about confidence, like that's the thing I've always wondered is if they've talked about like this as being a kind of a vibe session, like it's not a recession, but people feel like we're in a recession.
Yep.
I mean, why do you think, what are the big reasons this confidence just hasn't come? I mean, I think you said it's starting to come now, but like, why is it taking so long?
I think there's a host of reasons. But I think the ones I guess I'm most inclined to, I think the 24/7 news, not only that, but news that we, isn't any further than a foot away from us 24/7 a day, is a new phenomenon. Like I said, back when I started, we work all morning, then you go to lunch to see what the Dow was doing. I've come from that to where, I can't wait 2 minutes to keep, looking on my phone. The problem with news, as we all know, just in the selling of investment research is, what grabs your attention are the frightening headlines. You don't read the one that says it's sunny today. You read the one that says there's going to be a storm. And I think we get fed that on a regular basis. And with video now, the ability to transmit that, we can transmit a lot of news stories that you see. I always think that would never be a news story except someone has video of it. And that's the only reason it is. And that affects you emotionally in a different way than reading it in the New York Times or the Wall Street Journal or something with emotional video. And most of that's bad news. I think that's part of it. I think the internet and 24-hour technology is some of the issue that lends itself to greater pessimism. But more specifically to the cycle, I guess, I would point to, I think, I don't ever remember another cycle. We just went through a very unique pandemic cycle, which was kind of like a war with a domestic death count. Okay. And it wasn't something, it affected economics and the markets tremendously greatly, but it wasn't really an economic issue. But we went through it, and it was a death versus life issue for everyone in this country. I can't think of another one like that almost. Wars, people that went away to wars, but this was happening indiscriminately across the country. And I think that left its mark. I think it also caused everyone to be isolated for a period, which, left to your own devices, you can dream up terrible outcomes. And we kind of did it to all of us overall. And then we had this Fed response and the response of the corporate community. I don't remember. I mean, for a while there, every corporate CEO, led by Jamie Dimon, would tell you every week that a recession is imminent next week. We did that. We did it all the way from 2020 until just recently almost. And so corporate CEOs would tell us that. And certainly the Fed would basically tell you that. It was, we had the inflation surge, everybody, and then the Fed was tightening all the way down when they should have been done tightening at the peak of inflation. They just kept tightening for 2 more years. Which screwed up the whole cycle, if you will, too. So I think that was some of it. The Fed sort of not tightening soon enough and then tightening far too long over the case. I think that the political divide we have in this country, the blue-red divide, somewhat is a massive divide and more extreme views in this country. We don't have so much of the bell-shaped anymore as we have 2 bells on either side, and maybe the middle's hollowed out. Is more of a volatile situation. It leads to greater pessimism, a sense that something's not right in the country, which is contributing to some of that. I also think that there's just a general disgust with the whole process, whether you're blue or red. There's just a disgust, a sense of dysfunction at work, which gives you a sense that no one's leading.
One of the interesting things, obviously we talked about this a little bit before. 24/7 news is not good about this. He talked about the idea about how like reading something negative in the newspaper is totally different in how it hits you than seeing a YouTube video with something negative. So maybe this type of media we're getting is making us more negative. There's a lot of reasons, but I thought he did a good job highlighting what some of them are.
Totally. He did a great job of laying this out. And I would say I don't know how old Jim Paulsen is. This isn't to call him out on his age in any way, shape, or form, but we all have to remember we're a product of the world we grew up in, the household we grew up in, the parents who raised us, and sometimes the grandparents who influenced them, depending on, everybody's experience. This idea that, so like we're in the cohort where we still remember life pre-internet everywhere. We have a different attachment to news and things that we read in traditional places. Did you ever have, either for work or otherwise, like you had a Wall Street Journal paper subscription? Is that part of your life?
Yes. Yeah. At one point, definitely.
So there was a point of your life when that hit you and you looked for the back page of the C section and whatever else to get some hot value stock ideas or whatever you were doing,
I was in the penny stocks, Matt. That's where I operate.
The penny stocks operating there. But we had this experience of like taking stuff from reading it before it was widely available online, and then with it available online, shifting that habit so you could presumably find your penny stocks in the Yahoo message boards or something, right? But we have a whole other generation coming into this right now, and now starting to age up. Like they're not 20 years old anymore. They're mid to late 20s, they're early 30s, that they've grown up chronically online, and they're going to process information in a totally different way as they come into these peak earnings years and everything else. It's a really interesting cycling through of the awareness of how we consume this information. We got a whole other generation of people now that are investing, and look no further than Robinhood and the crypto stuff and everything else, all the degenerate gambling that's going on. Got a whole other generation that processes information differently at the same time as we're phasing out an older generation. That's going to impact everything with the type of pessimism that he's talking about.
The other thing I thought was interesting is this idea of the current generation or the younger generations are not borrowing like the older generation did. And that has a bunch of implications in terms of like, if there's less debt, then there's less risk. I'm trying to think through what it means, but it's very interesting. It plays into Bob Elliott, what he's talked about, the income-driven cycle, why this cycle didn't behave like other cycles because there wasn't as much debt. But I'm trying to think about what that'll mean for the future if these younger generations are not using debt in the way the older generations did.
I think there's a totally different attitude for it. And I mean, so me as a 43-year-old, it's basically, I saw the tail end of the tech bubble. I didn't have any assets at that point in my life. And at the same time, like I was aware of that recession and what it meant through. And then I watched both because I was in this business, in the industry and whatever else, I saw the global financial crisis and all that came with. That shapes your behaviors and your awareness about what can happen. It's like you see these big declines, you see recessions, you know people, friends, family, whatever else who lose jobs, or you barely hold on to yours or your business or your career. That stuff changes the way and your attitudes around the lifestyle you want to have, the debt you're willing to take, and the things you're willing to finance. We've got this embedded generation now in here, especially I think in our age range, in that like 40 to 50-year-old demographic, very young, or the oldest millennials and like a core part of Gen X, where it's just, we have a different attitude about the risks that we want to take on. We don't want to be leveraged up to the gills or buying like the boomers McMansion necessarily. Some of us are out there, but like, does that resonate with you? I feel like there's a change in awareness of a lot of my peers. And I think it'll be really interesting to see if the 20-year-olds today get more comfortable with debt or not. Because right now there's this whole generation in the middle and around peak earnings who are probably looking at a lot of this stuff going like, do I want that? Do I need debt to buy this thing from this person? What do you think about that?
Well, obviously this might not apply to me because as people who've watched this know and how exciting I am, like obviously I'm using reckless levels of debt.
Right.
Across
All your
everything.
boats,
I'm just,
the
yeah,
houses.
I'm at the casino on a regular basis, just throwing it all down. Yeah. So this may not apply to me. I'm basically the opposite of the other generation, but like it does interest me from the perspective of like, I'm wondering if like this limits economic volatility going forward. I mean, if you think about it, I mean, debt is one of the things that causes a lot of volatility. It causes booms, it causes busts. And if we're going to have less debt, if people are going to use less debt going forward, does it become something that brings in economic volatility over time? And just like we went through with this recent thing where everybody was like, the Fed hiked rates, we got to have this big downturn, and we didn't have it. Like, is that more the type of thing we see in the future?
I think it does. And with the financial planning hat on and direct out of experience, I'll tell you, there's probably never been a greater wave of clients in their 60s who, as they're approaching retirement, hell-bent on and very happy to like pay off the mortgage. So even if you're staying in the house, trying to figure out how to be debt-free before that retirement age comes, that is not a painfully regular and like a pain-inducing way, but I can't tell you how often people are like, well, if we have the chance to get out of debt before we pull the trigger on stopping working and converting to consuming assets versus saving them, it's a really common experience. So at multiple levels, people are trying to take the risk of debt usage out of their lives and therefore pulling it out of the system. That helps breed, I think, more economic stability because you have less chances of liquidity crises in a number of these pockets. We'll see what happens with real estate. Obviously, that's always going to be a wild card because people have to live somewhere. But I think we're undergoing a big shift here, and it wouldn't surprise me if this is a 20-year run.
So this next clip gets to this income driven cycle that I was talking about. But we asked Jim, one of the things all of us have noticed is there's all these indicators that predict recession. Obviously, the yield curve inversion is one, but there's a lot of other ones that people would consider leading indicators. And some of those, at least, and some of the major ones, were calling for a recession and called for a recession for a long time. And we'll eventually get one, but we didn't get it anywhere near where we would have expected to get it. So here's Jim talking about why that is.
What's happened in this cycle is every known recession indicator that anyone has ever known about has been blown to smithereens. None of them have worked. The yield curve didn't work. We had that surge in inflation 2022, didn't work. We had the leading economic indicator be negative year on year for like 20 some months, didn't work. We had M2 money supply year on year was negative for 16 consecutive months after never being negative year on year in its whole history. No recession. Of course, we had an aggressive rise in the funds rate, an aggressive rise in bond yields, with it, and no recession. And there's others too that, the sovereign rule. My point is we are left rudderless at the moment because no one knows of any recession tool that they can depend upon that still work. And that's a curious situation to find ourselves all in. And in my career, we've never had that. There's always been some tools that were still sort of working. And so that's sort of intriguing. So what I fall back on is I look at the recession risk more in terms of vulnerabilities than I do about necessarily policies and what they've been doing, more about vulnerabilities. And what are the vulnerabilities? And when I'm talking about the vulnerabilities of the private sector, and I don't see a lot. I don't see a lot of vulnerabilities. If I look at the household sector, they got debt ratios, debt to income ratios that have been falling since the '08 crisis, to your point earlier, Justin. They peaked in U.S. history at that point of becoming down resets. The ratio's now back down to its levels in the late 90s. We've never had this period of 15 years of declining debt to income ratios in the household sector. And the debt service ratio, principal interest payments to percent income, is down to its lowest levels recorded going back to 1980. No one's really borrowing money. Yeah, there's credit card usage because no one uses cash anymore. And yeah, there's some auto loans and a little bit, but basically the amount of debt use of household is way down and never really came to this part. Not only that, but their equity levels are way up, their net worths, and more importantly than that, their liquidity is through the roof.
I have to admit, I got this wrong. I mean, we've talked about this in other podcasts. I mean, things like the yield curve inversion, as a quant guy, I don't really put much stock in that because there's so few observations that even though it's 100% successful historically, like there's just so few observations. And also it's like, it might happen in 12 months and it might happen in 24 months. It doesn't help you with the timing of anything. But even beyond the yield curve inversion, all these other leading indicators, they didn't work here. And I think, he talked about in the clip, I think it gets back to this idea of the income driven cycle, is that when you have debt on, these indicators probably work a lot better than when your boom was driven more by income.
You know the Seinfeld episode where the cars, like the gas gauge is on E, and you're going to find out how long you can drive with the tank on E? Like, this is how recession indicators feel to me. You can't see inside the tank. So even if your indicator is on E, you don't really know when it's going to run out. You know it's going to run out eventually, but you can't really know how much is left inside the tank or how the car is going to handle it or whatever the situation is.
Do we know, by the way, is there like a standard for that? Is it like, do the car makers say like you should have 30 miles left when it shows 0? Or I've always wondered about that because it never actually runs out at 0. I mean, my wife takes it to 0 almost every time, and she never runs out of gas.
Yeah, even with the range calculators, like there's some, whatever the margin of error is in these.
They obviously understand human beings are driving the car, so we're just going to go ahead and like lie in terms of what the numbers say.
Yeah. We're going to deny it all the way to being stopped on the side of the road with nothing left in it. So presumably your wife can pull in and be like, it's been on E for the last 2 days. You need to go fill up my car. You shoulder the risk of going out to get it. But just this idea of like the old indicators don't work when the underlying realities have shifted. Like we still can't see into the gas gauge. We still can't know what the thing is that's going to tell us when this great downturn is here. And I don't know, like I'm with you. The yield curve indicator is it's just a handful of samples when it works. The most important thing to me is always going to be what's happening that's slowing down the consumer. And so Jerry Seinfeld inflection, like, what's up? What's the deal with the consumer spending? This idea of like, what's actually going to slow people down enough, because a recession it's a feedback loop on behavior. And that's one of those really impossible to predict in advance things, or at least at the right time. That's a spiraling activity. It's really hard to know until it's already deeply upon us.
Yeah, I don't think I'll be launching my macro newsletter at any point because if these guys have no chance of predicting it, I certainly don't.
Well, launch that macro newsletter. We'll apply a bunch of Seinfeld indicators to it. What could go wrong?
Probably nothing. So this next one is this idea we've been talking about a lot, and a lot of people are talking about a lot, that the Fed was behind the curve with this whole thing, and the Fed was behind the curve, in this latest cycle. But Jim put it in such a way, going back to our point at the beginning, he put it in such a way I've never seen it put before in terms of what the Fed was doing based on what inflation was doing. So here's Jim talking about that.
To tell you the truth, I think one of the biggest mistakes we make as investors sometimes is we put too much reliance or give too much authority to the impact of our policy issues, to what they do. And I think this cycle has been a fantastic example of that. Here's the Federal Reserve that literally didn't start lifting rates until 2022. And then by the time inflation peaked at 9.1%, I think the funds rate was still around 1% that quarter. Okay. But then once inflation peaked, bond yields quit going up, commodity prices rolled over, everything started coming down. Then the Fed went on a regular aggressive tightening cycle, and there's no other Fed that eased all the way up a major inflation cycle that have tightened all the way down. And Um, the question, is why? And I think it reflects the fact that our policy officials are really heavily influenced by their institutionalization. Uh, you know, and the the fiscal authority has always been that way in politics arena, and it's kind of always been I think, held out as the dumber policy. The monetary policy, when I came of age with my economics degree, I came of age, the whole thing out of the 70s and early 80s was that the Fed was mute. They didn't say anything ever. There was 6 months after the fact, there was like a one paragraph page that went out on what they decided to do 6 months earlier. Nobody gave a press conference to talk around the country or the Fed. The whole idea, the theory of the Fed was the only way the Fed could have impact was if they shocked the market, surprised the market. That was the thought. That's come 180 degrees where today's theory is it has to be all communicated. We don't want to shock any financial market. We want to fully aware of what we're going to do. But what that really tells me is we've now thrust the Fed into the political arena, into the public arena in a big way, to the point where you now have regular press conferences by Fed officials. And I fail to see the value in all of that, quite frankly. But I think the Fed, in part because of political pressure, was hesitant in the middle of a pandemic, and maybe understandably so, if I was the head of the Fed, in the middle of a pandemic while people are still dying, to raise interest rates, even though inflation went. And then once they finally decided it was okay to do it, they proceeded to do it even though they didn't really need to do it. And I'll tell you why that it didn't matter. The Fed was late tightening, late to ease, and it hasn't mattered. Stock market keep going up, economies keep going up, no recession. Who cares what the Fed did? And I think, why is that? It's because what really matters is not the institutionalized policy efficient decisions. It's the most important policies. That's what I call laissez-faire policies. It's what you and I decide to drive economic policies depending on our decisions every day. It's driven by the 330 million independent economic agents make decisions on how much cash to hold, how much to borrow, whether to get a job, whether to find a different job. That stuff is driving policies every day, and it does it on a really good, timely basis. Now, here's the example. Right when the pandemic hit, the money supply shot up to like 24%, something like that. Fiscal juice went up to 18%, the deficit spending as a percent of GDP. Bond yields went to 0.5%, almost instantly in 2020. Okay. The dollar collapsed. Massive stimulus was brought to the party on the pandemic. That is what kept the recession from being deeper than it would have otherwise been, was the myth. Now, did the Fed make any decision on any of that? Zero. It was all of us that zoomed the money supply up because we all went more liquid. And bond vigilantes pushed bond yields down. Fiscal juice went up primarily. We didn't pass much right away. Primarily, it went up right away because tax receipts went south and normal expenditures went up with greater unemployment claims. And so we had this mass stimulus that brought us out of the pandemic. And then, long before inflation peaked, all of these policies started to tighten. By the time inflation peaked at 9.1% in June of 2022, the money supply year on year, the real money supply, had turned negative. Okay? It was negative long before. It was tightening a year or more before inflation peaked. The dollar had gone up over that period. Bond yields went up to 3.5% by the time inflation peaked, long before the Fed even started to get into the game. And fiscal juice went from minus 18% deficit spending to minus 3.5%. So the Fed didn't tighten, but everything else did. And fortunately, it caused inflation to roll over. And then once inflation rolled over, the Fed started tightening, but everybody else started easing it. Money supply has been climbing ever since, and bond yields stopped going up and have been more sideways. And I think they would have come down again if the Fed wasn't holding rates up over that period. The dollar came down over that period. Fiscal juice went back out from 3.5% to 7.5%. And so while the Fed didn't tighten soon enough. Fortunately, everybody else did. Laissez-faire did. And while the Fed kept tightening way too low, unfortunately, everybody else eased. Thereby, we killed off the post-pandemic inflation and we avoided a recession. No thanks to the Fed. Now, that's my caustic view of it, but I think that there's much more important things going on in policies themselves that are driven by you and me outside of fiscal and monetary efficiency, if you will. And often they're the more important aspect to keep an eye.
If you think about it, he is right about this. I mean, the Fed was basically cutting the whole time inflation was going up, and then they were raising the whole time inflation was going down. So you can argue that they've got the timing completely wrong here. And I'm sure, first of all, it's hard to do what they do. And they're looking at backward-looking data, so they don't necessarily know what inflation is doing today. They're looking at backward-looking data. So once we knew what inflation was doing, it's easy to correct them on that. But he is right about that. And I think part of that is the Fed just hadn't seen, just like the rest of us. I mean, I didn't really know how to respond to inflation because I hadn't seen it in my whole career. And I think to some extent, the Fed underestimated what inflation was going to be because it always come back down in the last 30 years.
Just this idea of the institutionalizing of institutions and how this stuff shifts to go from a Fed, as he explains it, that doesn't have to communicate anything. That's supposed to basically acting on surprise is the theory of why the Fed works. To now, back to the comment earlier about AI is going to redline the Fed statement like in a split second after it hits the wires. And you can pull it up on Twitter or pull it up on your Bloomberg or your FactSet and see exactly what it says. Now the Fed has to communicate everything, and that's the way it's seen as doing a good job. Is it any surprise that like the communication policy and what we're paying attention to is just kind of like baked into the result? Right now, and I would argue this, it's like the treasury policy and some of the other stuff with the stimulus, like those have been the surprise supply things have actually moved markets the most. I think about COVID, think about the relief programs. This mix, we're not equipped to deal with this. And the Fed policy feeling behind the curve is another reality. We just have to acknowledge that it's there. This is not working the way that all the textbooks are telling you it works. So maybe stop looking at the textbooks.
Your point about forward guidance and then saying what they're going to do, our friend Cullen Roche, who I believe what you refer to as the roto-rooter of economics, something like that.
I think so. That's still an accurate description.
Yes. So anyway, he has this great thing where he compares the Fed to Chuck Norris, where Chuck Norris doesn't have to do anything to you. He just has to tell you what he's going to do to you, and that's more than enough. And that's basically what the Fed has to do. They just have to tell you what they're going to do, and that usually moves markets.
Yeah, and it's really interesting when we think about the Fed policy versus the Treasury policy, which gets much less attention, but is much more impactful in the last few years. But that Fed policy is just them over communicating what they'll do and then not actually doing it shows up in the data in some really confusing ways. Check your indicators at the door. Fed policy Chuck Norris is coming for you. Thank you very much, Cullen Roche, for that gift that keeps on giving.
And before we go to our last clip, the other point he made, which I think is really important, is all of us overemphasize the role of the Fed in all of this. Like we all think like the Fed is moving and the economy is going to slow right away and everything's going to change. And the reality is, number one, long rates impact the economy much more than short rates. And the Fed directly doesn't control long rates. Now they impact long rates a little bit with what they do, but they don't directly control it. And the other thing is, if we are in an income-driven cycle versus a debt-driven cycle, then rates as a whole have less of an impact than they used to. So it's not like the Fed is going to do what they're going to do and suddenly, and we saw this because obviously the Fed has been hiking a lot and we haven't had a recession. So I think all of us just have to take a step back and say the Fed might not be as important as we think it is. The Fed is certainly important, but they're just not like decreeing whatever they do from the hilltop and then the market is just doing what they want.
So you're saying basically the Fed is the unquantifiable passive bid of all these arguments. It's like another...
You have one Mike Green commenter on the channel now. So every video we do, we get a comment basically, you've missed the work of Mike Green.
Timestamp this in the comments, please.
I think you could do an episode on like how you bake your famous lasagna or something, and it would be like you have not taken the impact of Mike Green's work into the construction of this lasagna.
Well, listen, my Fed
Mike
indicators,
is a good cook, by the way, so he could probably add a lot to your lasagna. Mike, cooking is a big thing of Mike's. So
and he could do it on an RV better than most of us could do it in our kitchen.
That's right. He was doing it traveling around the country. So anyway, before we digress too much, we should probably go to our last clip. So we always ask everybody at the close of every interview, what is the one lesson you teach the average investor? Here's what Jim said.
I think the biggest thing, maybe it's nothing new, but it's just true to me that, as a professional asset manager for many years, the reality is, I think we impact just a small, poor part of incremental return. I mean, probably less than 10% of the total result is going to be due to our decision if we add value. We're talking 10% or less that we add, truthfully. Because the reality is you take in a pot of assets and the vast majority of it is already spoken for. It has to be this much diversified. It has to be here, here, and here. And then you're really only playing with the last little bit of it as your bet overlay on top of it. And I guess I really kind of believe that we're just adding a little bit on the end. The worst sin you can do as an asset manager is lose track of the fact you're trying so hard to put your footprint of outperformance on it that you blow the other 90%. And that is, you get too bearish, whatever, or too bullish and get it too aggressive or too conservative. Probably more, you can get yourself too bearish and you miss out on the way most of us make most of our money. That is, we're just there. You're just along for the ride. Because again, the markets go up 10% a year over time. We might add 1% to that, maybe if we're good or whatever, lucky or whatever. But we don't want to lose track of the fact that it's the biggest part, just the market itself, not us, that makes that. The only other thing I'd say is that realize that it's okay to be wrong in this business. It really is. If you're not wrong ever, which the only way I can think you can't be wrong is that you're basically a closet index. That you sell yourself as an active manager, but you're a closet index because the way you're never wrong is you never take a bet. You're always just indexed. And if that's the case, you won't ever underperform, but you really won't ever add any value for the client as well. And so the only way to add value is to take risk. And that means whenever you take risk on a regular basis, you're going to do wrong sometimes. And I think that's okay. That's okay to realize. It's okay to tell your clients. And I guess those are the things I'd say. And most of those are learned from humbling experiences myself over years.
I think this is great because it's important when you do anything for investors to take what you do and put it in context. And so Jim is a macro strategist. He throws macro strategies out there. He could easily, like a lot of people who do that, say, my stuff is so important to you. You've got to follow everything I'm doing. And he admits what he's doing is really the 5 or 10% of your portfolio around the edges. And when you look at this stuff as the whole portfolio, his job is not to mess up the entire portfolio with the 5 or 10%. And I think there's so much all of us do in investing, even if we're not a macro strategist, where we can blow up the rest of the portfolio with the 5 or 10%. And I think that's just such a great lesson, even if you're not a macro strategist like he is.
And I think it's a Seth Godinism, an amateur, what's the line? An amateur does what they love, a professional loves what they do. This is Jim as a professional. It's like, I love doing this. I understand the only way I take value is to take that active risk, is to go out on that ledge, is to not be the index investor. And I actually love doing that, even when, nobody loves it when they're failing or when they're getting redeemed or when stuff is sucking. But understanding that I love what I do. I love the process of studying this stuff. I love the process of putting it together. And I'm not just an amateur hobbyist doing it. So this actually matters to the people who are allocating to me. This actually matters to me being humble about the role I play in that portfolio and the lane that I said I'm going to be in this lane and then sticking in that lane. Easy to say, hard to actually do. The way he answers this question lets you know he actually understands that role that he's playing. That's a true pro right there.
And the other thing is he talks a little bit about the closet indexing at the end. And I think my overall point with that is, if you're going to be something, if you're going to charge somebody to be something, do the thing you're actually charging them to do. And I think you see so many people, not just in his world, but in the world we operate in, you have so many mutual funds that just own the S&P 500 and charge a high fee to do it. They don't say they own the S&P 500, but they effectively own the S&P 500. And that's worked really well recently. But I think it's important, like, if you're going to try to add value, try to add value. Be different than the thing you're trying to add value to.
Be different in a way that you can articulate because you actually believe in it. And that's, again, easy to say, hard to do, but there's a lot of true amateurs out there who love what they do. They're going to talk about the trading or they're going to talk about this other stuff, but there's not actually that process behind it that they're going to stick to even when it's out of favor. not just a love letter to the value investors, but also a love letter to the value investors. Have something you actually believe in, because look, this is all these clips in this show and every single other one. Find the thing that you can stick to. That's the name of the game, right? Over and over and over again.
Yeah, I think that's it. I mean, we could probably do our 1 minute podcast in the future and save people having to listen to us for an hour.
But what fun would that be? So you're saying we're the closet indexers of podcasting? We really could say one thing,
that's I'm the closet indexer of life. That's basically what I just tried to do. But anyway, that could be a whole different episode where Matt psychoanalyzes me. So we won't do that here because nobody wants to hear that. But I guess that's a good note to wrap up on. Just from what I mentioned before, click beta, Matt's new podcast. Subscribe to it. It's really, really good. Dave Nottig, Jason Bucks, two of our guests that our audience has loved the most over the years. So it's really, really good stuff. Subscribe to it. And thank you for joining us, and we'll see you next time.
Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
Jack Forehand is a principal at Validia Capital Management. Matt Ziegler is managing director at Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital or Sunpoint Investments.